You're saying, hey, inflation is really hot. Why aren't gold and silver going up? And I said, well, they already went up to account for inflation. That's what happened in 19 and 2020. The metals tend to look around the corner. And so what I think the metals are doing right now, technically you can see it in the charts. What I think the metals are doing right now is they are sniffing out the ultimate Fed pivot, which won't be a hard pivot unless things really break. But it'll start off as being a soft pivot, or the rate hikes will slow down, and we already see that. Maybe they'll do 50 tomorrow, we don't know. And then they will stop. And then, of course, as things start to break, they will eventually go the other way. And I think ultimately they'll abandon QT and so on and so forth, because as we all know, you can't really taper a Ponzi. So, and to me, what's going on is the metals are smelling it. And that's why I think they hit their bottom for this cycle. And I think they're going up. Now, I could be wrong. There could be something that surprises me or us, and we have one more dip down to the lower levels of 3-4 months ago. But it feels to me like we put in a bottom that's going to last. It took 2 years to do it from the high in the 2020 range. So, it's a pretty big correction, and they've come down significantly. And of course, it's a higher low than the last time around. And of course, as I've said in other podcasts, I think this is a big one, because when gold gets through the 2070 area, when silver gets definitively through the $30 area, they'll be, in the gold case, not in the silver case, but in the gold case, it'll be at a new all-time high, and the silver case will be headed back to that $50 high, and that would be a breakout. And so I think we'll really get some momentum going there.
Yeah, it's certainly going to be interesting to see what happens when silver gets over 30. We've seen it touch right underneath that mark a couple of times in the last few years, and I continue to wonder many days if that's a bit of the line in the sand there. Although something else you mentioned in terms of seeing the markets break, we're watching some historic interest rate hikes that we haven't seen this pace before. Now, throughout that, we've seen trouble with the yen, we've seen trouble with the gilt market, we see banks teetering like Credit Suisse and people withdrawing their money. Are you surprised that we haven't, I don't want to say that we haven't seen a breakage in the markets, because obviously real estate, stocks, bonds, all down quite a bit, but not something quite like 2008 just yet. Are you expecting that, and surprised we haven't seen something like that already?
That's a great question, Chris. Yeah, I'm a little surprised. I thought things might break a little more severely, a little more quickly, but they haven't. There's a lot of free money out there. It's still sloshing around. But yeah, remember, this has been the worst year in bonds in, 30, 40 years or more. It's been a pretty bad year in stocks. It's very rare that both of those go down. Generally, if stocks go down, bonds go up, and vice versa. So, and we have seen cracks. The gilt market was a really big clue, in my opinion. The blowout in the Spanish or in the Italian yields was another one. More recently, some recent cracks. We saw Blackstone gating their real estate fund, and then Starwood followed suit. We're starting to see things break. The Fed's remittance to the U.S. Treasury has gone deeply negative, because they're paying out a lot of interest to hold the RRP money in place, and in turn they're not getting as much interest income from their bond portfolio. So we're seeing cracks, and obviously the housing market has gone completely dead. Interest rates, mortgage interest rates are up probably the most in history, bouncing around 7% for a 30-year now. It used to be 3%. We've seen the new car new car sales, and car sales are down substantially. I think they were down 25% month on month. That's one of the biggest ever. So, I like this phrase that Mohammed El-Arian said. He said, the Fed slammed on the brakes and the economy is in the process of going through the windshield. But the process takes some time. And I compare it, it reminds me a lot of the 2007 and 8 time frame, when we all knew there was a housing bubble, or many of us did, not everybody, but a lot of us did. You kind of see it. And in the summer of 2007, two of the Bear Stearns funds blew up that were dealing in the real estate stuff. And that was like the early warning sign. And of course, Lehman didn't go bankrupt until September, October of 2008. So what is that, 15 months later?
Right.
And the Fed started this rate hike cycle in February of this year, and they got really aggressive about it over the summer and the fall. So it takes some time for those things to flow in and through the economy. But I think the flow is taking place. And, if you kind of assume the similar amount of time from the change in conditions to it really becomes critical, a year to 18 months seems realistic to me. So that would imply I foresee that we're going to really things are going to start to break, and the Fed might have to pivot quite aggressively in Q1 or Q2 of next year, as all the economic numbers start to go in the wrong direction. So that's kind of how I see it unfolding. I could be wrong. It could take longer. Could happen short. It could happen tomorrow. We don't really know. We obviously saw, the crypto blow up and FTX. Another good example of, liquidity affecting speculative areas. I read this morning that venture capital, there's a site called Forge. I read it in Barron's, that a site called Forge that keeps track of venture capital pricing. And they make a secondary market in private equities that are done by venture capitalists. And the average discount off of the last round valuation for the secondary market on venture capital deals right now is about 50%. So that means that all these unicorns that were getting, valuations of $1 billion a year and a half ago, if you want to sell your stock in that, you're going to get a 50% haircut. And I think that'll get worse. So what we're seeing is, the process of the monetary tide going out. And obviously the Fed had to do this for political reasons because inflation was, scorching hot. And, they'll get some decent inflation news. They'll redefine the target upward. Suddenly unemployment and the health of the economy will become a bigger issue, and we'll be back at the printing press pretty quickly. Importantly, also, I think, Chris, is to look at the, the budget deficit. And Luke Rome has done a nice job of pointing this out. The TBAC, the Treasury report that comes out every quarter, talked about how the government is now projecting they're going to run a deficit of about $1.3 trillion in the first 6 months of this coming year. Right? And I actually tweeted this yesterday. Last year's deficit was $1.4 trillion as recorded, but in fact, the debt level went up like $2.2 trillion. So, the government debts and increasing government debts, and if we have a recession, right? In fact, the November numbers just came out on tax receipts. I tweeted this last night. The Wall Street Journal had it. And tax receipts were down, I think 10%, and expenses were up about 6%. So, if the economy is rolling over, as I think it is, government finances are going to get worse, which means they're going to have to sell more bonds, et cetera, et cetera. So there are a lot of things. What I would say are cracks in the system starting to emerge, but there hasn't been a Lehman moment, with the exception maybe of England. Like Lehman, England did have a Lehman moment, and that to me is a preview of coming attractions. That others will have a similar moment. And for those who don't know, what happened over there is they announced tax cuts, and they announced spending increases to cover electrical bills, and the pound started to fall very quickly, and the gilt rates started to go up very quickly, and then basically the pension funds that had used something called liquidity-driven investing or liability-driven investing had levered themselves up. They couldn't handle the higher rates, and they were close to going bankrupt if the government didn't bail them out. Of course, the government bailed them out. So the point is that everybody, absolutely everybody in this economy is out over their skis in terms of, free money. And the money's not free anymore.